What's up, YouTube? Today I'm going to talk about day trading and, in other words, the PDT. What is that? This is Todd Horse with Tasty Tracker. So basically, I wanted to talk about this because there's a lot of misunderstanding out on the internet, um, even from people that are experts or would claim to be. They don't seem to understand what PDT is. And I wanted to do a series on day trading, so this seemed like the first place to start. So, from the very beginning, what is day trading? That's when you open and close the same position in one day. Each broker is going to consider day trading a little bit differently. And it's usually based off of your open, but things get real messy when you're talking about options. So let's first talk about stocks. You buy a stock, you sell a stock. That's one day trade. If you buy 500 of that stock and sell 500 of that stock, that's still only one day trade. Now, if we're going to talk about options, if you buy, say, a spread, a call, credit, spread or vertical, whatever you want to call it. If you buy that and then sell that, that would be one day trade. Now, if you do another example here is you do a call, credit, spread. Again, same thing like I just said, but this time you only buy back the call that you sold and you leave the call that you had bought on. That still counts as one day trade. So even though you didn't close out of the entire position, but you closed out of a piece of it, you're still going to get stuck with that. Now, here's another scenario. One time I purchased 3 separate verticals on SPX, but all of the call strikes were that I had sold were the same. It's just the ones that I had bought that varied from each position. So at the end of the day, I had 3, and I closed out. I bought back the ones that I had sold, all 3, and even though they were on 3 separate instances, 3 separate verticals that I had opened up, because they were all for the same strike, they only counted that as one. That was on Tastyworks. But each broker you have is going to determine what a day trade is, possibly slightly different. So I guess that maybe that's part of where some of the misunderstanding comes from with day trading. But ultimately, there's a lot of different variations. If you have any questions, obviously talk to your broker of choice. But that's the general concept. Typically, when you're talking about day trading, a lot of people do this with stocks, but as we talked about in the options video, that requires a lot of capital to do. So if you're day trading options, you can do the same thing that you would normally do with stocks, and it can provide you large, quick gains. But again, with options, because they're so leveraged, it could also be a big loss for you very quickly. So back to PDT, which I briefly mentioned before. What is that? That's the law, and that's saying that if you're in America or your broker's in America, you're going to be held to the PDT rule. There is no broker that can get around this unless you're outside of America. Again, but everybody in America has to be under PDT. That is where you do 5 day trades, or 3 day trades within a 5-day period, sorry. If you were to do that, if you do exceed that, so you do a 4th day trade within a 5-day period, then from there on your account's going to be locked from opening positions, and you can only close any existing positions that you have open. So they won't totally lock you out of your account, but you just can't open any new positions for 90 days. Obviously, that's pretty detrimental, especially if you have a larger account. So in most cases, if you're coming up on your 4th day trade, you might want to even consider just letting it be a loser, because the amount of money that you could make in 90 days is probably greater than the amount that you're losing on this one individual trade. If not, you're probably betting too much on that trade anyway. But here's where it gets tricky. So people talk about different ways to get around PDT, and they say, I can do this, I can do that to get around it. You're not getting around PDT, it's the law. But the law says that it only applies to margin accounts that are under $25,000. So the easy way to get around PDT is to either not have a margin account, that would be just a cash account, or have more than $25,000. If you have a cash account, you can do whatever you want with your money whenever you want. But the problem is you have to deal with clearing time or settlement. For stocks, that's 2 to 3 days. For options, that's 1 to 2 days. However, it really depends on your broker and how quickly they can settle things. So, right here I have a note. Some brokers may take longer to settle options than others, and PDT has nothing to do with settlement time. So we'll get into this in a second, but I use Tastyworks to do most of my trading. Their settlement on options is instantaneous. If you use Robinhood, your settlement is going to be at least 1 day for options, and then the 2 to 3, they'll basically always hold you to that time, whether it's settled before that time or not. They're going to hold it, which is weird. I can't imagine that it would take that long to settle, but whatever, they stick to those times. So anyway, my last point on this slide is that when you want to start day trading, I would recommend doing it only with options because of how quickly they settle. And again, that's dependent on your broker. But if you want to day trade all you want, you need that quick settlement time. Another method people use to get around it is to have, say, 3 accounts on 3 separate brokers, each with margin accounts, and then you do day trading on your first account 1 day, your second account your second day, and your third account third day, and by that time the first account will have cleared all its funds. That is a way to get around it if you want to look at it that way, but the way I look at it is now you're only dealing with 1/3 of your capital, so it's really 6 of one, half dozen the other. I'd rather be able to be held to the 3 day trades per 5-day period with all of my capital instead of having to divvy it out, but to each his own. Next slide. Okay. So this is part of the series, like I said, on how to day trade. I'm not really going to get into that too much in this one, but instead I wanted to sort of give you a primer. So first question here, should I day trade? Honestly, I don't think you should at first. Swinging is a slower paced method of stocks or options, and again, I basically only do options. But it has a set of rules that you follow, and if this happens, you do this. If this happens, you do that. With day trading, it happens so quickly that you don't have time to think about or put your roles in. And because it's so fast-paced and less time, that increases the risk of day trading. And so that's why swing trading is less risk. So I have heard people on the internet saying, going the complete opposite end and saying anybody that's day trading is a scam and they're not making money. And I totally believe that's false. I've seen it directly. People can make money day trading options and stocks. So I don't know, why are you calling people out on scams? Anyway, yeah, that person may not be able to do it, but it is possible. I've seen it done. Will you make money? Maybe not. Maybe you'll never learn those skills, especially if you're not investing the time in it. It is different than swing trading, so you have to treat it differently. Sorry about the dogs. But anyway, is it a scam? Not at all. Again, I've seen it done. So what you really need to do to get started is to sign up with Tastyworks. I have a link in the description. And I start off with 300, but anywhere between 300 and 500 is a great way to start out. You need a cash account. Again, if you want to be able to trade with the full amount, as many day trades as you want, and it has to be on Tastyworks because their settlement is quick. Yes, you can do this on any other platform. I know Robinhood used to have cash accounts. I'm not sure if they still do or not, but every other broker is going to have cash accounts. I don't know that you can really convert from a cash to a margin and back again. So with Tastyworks, I have it on a future slide here, but I have one cash account, I have one individual margin account, and I have one IRA margin account. So you can have 3 accounts with one broker. I don't think you can do that on Robinhood. But basically, a normal broker, you can have multiple accounts with different settings. And so that's, I'll flip between accounts depending on what trade I'm looking at doing. At the end of each week, I'll get into this again when I show how I day trade. But I'm aiming for $40 a day off of this $300. That's a pretty risky ROI. In order to achieve that, I'm taking a lot of risks. So at the end of each week, you want to take out any extra money you have and stash that away. Whether you're going to buy stocks that are dividend or just investing or other swing options trades or whatever, you want to take that money out so that way you have less risk of losing it all, because you will end up losing. You'll have a losing week here or there, and you're not going to have any money left if you play with all of your money at once in this cash account. Some of the downsides to this cash account is you can't do spreads, because if you think about it, when you sell one option and then you buy another one, there's all of that money that you're not being debited or credited for in your account that normally the broker will say, yeah, okay, I see that if you subtract those two, there's a balance of only X amount, but the total value of those 2 contracts are much larger than what you would be paying up front, and your broker only charges you the difference on a margin account. On a cash account, you need the total value, and so they're just flat out not allowed, at least not on Tastyworks, and I don't think they're allowed on any other one. So yes, you can't sell calls or puts, you can't do spreads. Basically, you're just buying calls and puts and looking for the value of those options to increase. I did have a question recently about puts increasing in value even though the stock is decreasing. That'll be in a later video, but basically when you buy a put, you want the stock to go down. When you buy a call, you want the stock to go up. In both of those instances, if the stock does what you want it to do, the value of that contract will go up. So if you have a call that you bought, the stock goes up, the value of that call goes up. If you bought a put, the stock goes down, the value of that put goes up. So anyway, that's just a quick tidbit there. So I just wanted to give you a little bit of context or understanding here. Again, day trading is gambling. I'm going for a larger ROI. I play with a smaller amount of money, and there will be bad sequences, especially while you're learning. So you're going to most likely blow up your account. And so that's why you want to take any proceeds that you have at the end of each week, keep it in a separate account, or take it out, go buy something nice, whatever. The point is that you're not gambling that away, thinking that you are the best trader in the world. I've had plus weeks and negative weeks, and it's just one of those things. If I blow up my account, I reset the next Monday with a fresh 300 and go from there. But like everything else in the stock market, it does take time to learn. So you can't try for one day and realize that it's the worst thing, it's a scam, it's all fixed, you're never going to be profitable. That's not the way the stock market works. It's like any other job. You have to treat it like a job. You have to learn. And the market, punishes you at first, and that's your education. If you go to college, you would pay for that education. It's no different here. You are going to lose a little bit of money at first. The point that you need to focus on is controlling how much you lose to get that education. At the very beginning, I was talking about how swing trading is probably more appropriate for beginners, and the reason here I talk about it requires a lot of attention. You have to be watching the market. It is an art, You can't just be told how to do it. Even watching it sometimes isn't enough. You really have to experience it and continue to work at it and work at it. And then even then you'll still have bad days, obviously. But it's an art, so maybe you're not just cut out for it. But I will say, don't give up on it. After a week or two of trying and not having any luck. It's really important that you get a good entrance. The entrance is where you make the money. And then you need to be watching it on the exit. I usually set a limit sell so that I don't even have to watch the exit, but I'll still check in to make sure it's headed in the right direction. But it really is unforgiving. If you have a poor entrance, your entire position is shot, and you might as well just close it. I did that one time. The stock was moving too quickly, and I forgot to set a limit buy or a limit sell, a limit buy to open up the position. And so it came out like 20 bucks higher than what it was trading instantly down 20. And there's no way I could come back from that. I ended up closing the position shortly thereafter for like a $40 loss. So it can move very quickly. It is unforgiving. So make sure you're using limits when you're trying to enter in a position. You really have to be aggressive getting the bid price. Normally on a spread, especially when I'm doing swing trading, I don't really care about a little bit of sliding on the price. So I'm too impatient. I'll just get it filled, and I feel that buck or two isn't really a big deal. But when you're talking about these smaller plays, we're doing $100 plays, maybe $50 plays. Every dollar counts, and so you have to be aggressive trying to get the bid price and not just taking what the market's giving you at that moment. Obviously, with anything with options, you can't rush. Even though these are moving quickly and you can't dawdle, by the same token, you can't just start throwing stuff at the wall. It's going to end up losing if you're just trying to rush it in and make it work. And if you do make a mistake, like I said, just close it. It's better to lose those, 10 or 20 bucks than having a bigger loss on your hands. Anyway, look forward to the future videos coming in this series about day trading. It's what I'm focusing on at the moment, so that's what's most relevant for me. But I have the links in the description. Share, comment, like, subscribe. And then obviously my website is tastytracker.com, where you can track all your stocks and option trades. I have a feature that's new that you can quickly add an option trade. It has a minimal amount of inputs, and it's specifically built for day trading options. So that way you're not bogged down with entering things, but you can still get in and see what your break-evens are and what your percentage is that you want to get out with. Anyway, I have a referral program there that's great too, and it's only $9.99 a month, which is much cheaper than a lot of other tracking solutions. And I really do think it's worth your time. The money that you spend here is nothing compared to the amount you'll save when you start seeing where you're successful and where you're not, so you can hone in on your area of the market. As always, these are only for educational and entertainment purposes. And so if you have any questions, you can certainly ask below. Thanks.